The European Central Bank cuts interest rates for the first time in 5 years. Welcome to Market Insight. I'm Ramzan Karamali. Well, in a widely anticipated move, the ECB lowered its benchmark deposit rate by 25 basis points. It now sits at 3.75%. But what's the outlook for the future? Well, to help answer that and much more, I'm joined by Joachim Klement, Head of Strategy at Liberum Capital. Joachim, thanks so much for joining us. Well, it was really no surprise that the ECB was going to cut rates, but the market reaction seems pretty subdued, doesn't it?
Yes, the rate cut today was telegraphed well in advance, and the question really was all about what kind of an outlook does the ECB give for the rest of 24 and 2025. And there, the interesting thing is that its inflation forecasts have been revised upwards slightly. Both core inflation and headline inflation for 2025 are now expected to average 2.2% from 2 to 2.1% previously. So it's a slightly more cautious outlook for inflation in 25.
But I thought the battle against inflation had been won, Joachim. What's changed their minds?
Nothing really. It's the battle against inflation is progressing well. Inflation is coming down. But recent job market data and leading economic indicators point to a recovery, in particular in Germany, but also in the Eurozone overall. And that means that inflationary pressures will slowly start to build up again in 2025, which means that getting to 2.0 inflation rate, that last step, is going to take quite a bit longer than we anticipated at the beginning of this year. But that's mostly priced into the market already.
Why is it so important that they need to get to that 2.0 level percent? And what does that mean for future rate cuts?
Well, in the case of the ECB, actually, the ECB law states that the bank has to achieve 2% inflation as a target. But in general, it's obviously all about price stability in order to give businesses and households an ability to plan ahead and think about investments without being afraid of too high inflation. Now, where inflation becomes too high is a matter of discussion and a matter of debate. Central banks have decided in the 1990s that 2% is a nice number, but there's nothing sacrosanct about this number. And whether inflation averages 2 or 2.2 or 2.5% doesn't make much of a difference in the real world.
Now, the ECB have obviously blinked first when it comes to the Fed and the Bank of England, for example. Where do you see the Fed going?
We expect the Fed to cut interest rates in the second half of this year, but first of all, at a slower pace than the ECB. We expect the Fed to only cut interest rates in September and then again in December, while the ECB is likely to not just cut today, but again in September and December. So from now on, probably a parallel move between the Fed and the ECB. And the reason is simply that inflation at the moment is just higher, quite a substantially higher in the US than it is in Europe, which gives the ECB more room to cut interest rates than the Fed.
It's quite some contrast compared to the start of the year when we were talking about 5 to 6 rate cuts from the ECB and the Fed. A lot has changed in just, less than 4 or 5 months.
In the US, definitely, because the US economy has been so resilient and so strong for so long that it is simply impossible for the Fed to cut interest rates as often as 4 or 5 times this year. In the case of Europe, we have been in a recession in late last year, and we're now starting to come out of this recession. And the part that is really kind of limiting the ECB's remit and ability to cut interest rates is how stubborn services inflation is in Europe, given that the services economy is doing relatively well, much unlike the manufacturing economy, which obviously was not only in recession, but continues to suffer from weak demand from China.
And Joachim, what's your view on the Bank of England? I mean, today we had some figures out that said the UK construction sector expanded at its fastest pace in 2 years. Does that mean the Bank of England might be encouraged to cut rates sooner rather than later?
I think so. I think the Bank of England is moving very much along the same path as the ECB does, meaning that because the UK economy was in recession late last year and is now slowly accelerating out of this recession, inflation in the UK is very close to the 2% target. And that means the Bank of England has room to cut interest rates as soon as the next meeting on the 20th of June.
Joachim Klement, as always, many thanks for your thoughts. That's Joachim Klement from Liberum Capital. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.